Welcome to the Deep Dive. Today we're taking a close look at a company that's, well, pretty much everywhere, the Coca-Cola Company. Ticker is KO.
That's right. And we're digging into a really thorough investment analysis that you, our listener, provided. It's a fascinating look under the hood of just a classic global business, really.
Yeah, and our goal here is pretty straightforward. Pull out the key takeaways from this analysis, get a grip on the main arguments, and figure out what it actually tells us about Coca-Cola today. You know, its strengths, where it might be vulnerable, what the future could hold.
Exactly. We'll get into how they actually make money. It may be simpler than you think. Their incredible competitive strengths, how they handle their finances, and crucially, some of the big questions and maybe some surprising challenges looking forward.
Right, including a pretty provocative counter-argument later on that really makes you think twice. Okay, let's dive in. Where do we start with the core business?
Well, at its heart, Coca-Cola runs on what the analysis calls a brilliantly simple model, the concentrate business. Basically, KO makes and sells the syrups and concentrates, the secret formulas.
To their bottling partners.
Exactly. These are largely independent companies all over the world,
Yeah.
and they do the capital-intensive work, mixing the concentrate with water, sweeteners, carbonation, then bottling it, packaging it, and distributing it everywhere.
So KO sort of keeps the high margin, low asset part, the brand, the formula, the concentrate production, and lets the partners handle the expensive factories and trucks.
That's the core idea. It makes KO itself remarkably capital light and high margin. They've essentially outsourced the heavy lifting while keeping control of the really valuable bits, the brand and the intellectual property.
But the analysis mentions they do have their own bottling sometimes, the finished product business.
Yeah, that's right. Through their bottling investments group, or BIG. They operate some bottling plants directly, often in, say, strategic markets or places needing development. Plus, they sell finished products directly, like fountain syrups, to big customers like McDonald's.
Okay, so it's not purely concentrate. How big are those other parts?
They're significant. The analysis gives Q1 2023 numbers. North American finished products were around $3.9 billion in revenue, and BIG was nearly $2 billion. So, yes, substantial chunks, but the concentrate model is still the engine.
Got it. And the analysis talks about this model being simple but incredibly enduring. What makes it stick around for so long?
Well, it plugs right into basic human stuff, doesn't it? Creating drinks people like and then making them available everywhere. That within an arm's reach of desire idea. Plus, there's the habit loop. You know, the sugar, the caffeine, the refreshment that keeps people coming back.
And it's more than just the taste or the caffeine hit, isn't it? There's a whole cultural layer.
Oh, absolute crucial. Coca-Cola has spent over 130 years weaving itself into the cultural fabric. Think about the marketing, the associations with happiness, holidays, nostalgia. It's become this, cultural icon, not just a beverage. That makes it super resistant to just disappearing like some tech product. And the system itself, this huge global network, that's a key asset too.
Definitely. That's vital for the future. It's not just a soda delivery system. It's a platform that can, in theory, deliver any non-alcoholic, ready-to-drink beverage pretty much anywhere. That adaptability is fundamental if they want to keep growing beyond the traditional stuff.
Okay, that makes sense. So that leads us to the economic moat, the competitive fortress protecting this business. What's the main thing keeping competitors at bay?
The analysis is really clear on this. The number one moat source is intangible assets. Specifically, the sheer power of their brands, especially the Coca-Cola brand itself. It's probably one of the most recognized symbols on Earth. Global awareness is over 90%.
Wow. And there are numbers to back that up, for sure. Interbrand, in their 2024 rankings, valued the Coke brand alone at over $61 billion, seventh globally. But what's really amazing is the consistency it's been in the top 10 every year since 2000. Only Microsoft has matched that.
That's incredible staying power.
It really is. And that brand power creates what Buffett calls share of mind. It makes Coke the default choice. You don't even think about it sometimes. And that lets them charge a premium over store brands or less iconic rivals.
So brand is number one. What else contributes to the moat?
The second layer is cost and scale advantages.
Yep.
This comes directly from that massive global system we talked about. Over 900 manufacturing sites, 200 plus bottlers reaching over 200 countries, aiming for 33 million points of sale globally.
Trying to replicate that sounds daunting.
Yeah, prohibitively expensive, probably impossible for a newcomer. It would take decades and just unbelievable amounts of capital. And that scale gives them huge advantages in buying power for ingredients, packaging, whatever, and makes their global advertising spend way more efficient.
How does this moat show up in practice, like in their results?
Pricing power is the big one. The analysis points to fiscal 2024. During all that high inflation, they managed to get a 9% benefit from price and mix. Basically, they passed on rising costs, and people still bought the products.
Right, that 9% figure you mentioned earlier. And the analysis had that great example about the same can costing different amounts.
Oh, yeah, the tiered pricing. It's brilliant, really. That can of Coke might be, under 50 cents in a multi-pack from the supermarket? But in a hotel minibar, it's $5 or more.
Same product, vastly different price.
Exactly. The price isn't about the cost of the liquid, it's about the context. The convenience, the need state, the immediate desire. They're selling an experience, a solution to a moment, not just a commodity.
That really highlights the brand's power. So is this amazing moat stable, getting stronger, weaker? What's the trajectory?
The analysis rates it as stable, but with a really important caveat. It's stable relative to its direct competitors. They're still the clear leader, something like 40% of the global non-alcoholic market, maybe 45% of U.S. carbonated soft drinks, CSDs.
And the market share data in the source backs that up?
Yeah, it shows Coke's U.S. CSD share hasn't actually changed much over decades. It was 20.8% back in 95 and 19.2% in 2023. Pretty steady. Meanwhile, Pepsi-Cola's share has dropped quite a bit in that time. And Sprite, which is Coke's, has grown. So against rivals, they're holding strong.
But there's a bigger threat lurking, not a competitor, but something else.
Yes. The analysis flags a major category-level threat. It's the big, undeniable shift away from sugary drinks globally. Health concerns, The long-term strength of Coke's moat really depends on whether they can successfully pivot.
Pivot, using that brand and distribution strength.
Exactly. Can they extend that power into faster-growing areas like water, sports drinks, coffee, tea? That's the billion-dollar question. Acquisitions like Costa Coffee and Body Armor, the push behind Coke Zero Sugar, these aren't just side projects. They're absolutely critical for the Moat's long-term survival in this changing world.
Okay, so the fortress is strong against current enemies, but there's this big tidal wave of changing consumer habits approaching. Let's shift to the Skuttlebutt part of the analysis. What are customers and employees saying? What's the vibe from customers?
It's really interesting, kind of split personality. On one side, there's genuine love. People call the products classic, refreshing. They connect them to good times, nostalgia. The analysis even cites a pretty strong net promoter score, plus 41, with lots of passionate fans.
People really feel strongly about their Coke.
They do. But then there's the other side. Real and growing concern about health. The sugar, the links to obesity, diabetes, and also the environmental impact, especially plastic waste. Coke is a huge producer of plastic bottles.
So they love the taste and the feeling, but worry about the consequences.
That's the tension, yeah. And for KO, it means things like pushing low-sugar options and working on sustainable packaging aren't just nice-to-haves. They're absolutely fundamental for keeping that positive brand image and, frankly, maintaining their social license to operate.
Makes sense. What about the view from inside the company? What do employees think?
Well, the picture painted is of a classic large multinational, Lots of pride in the iconic brand. It looks great on a resume. There are global opportunities. Internal engagement scores are apparently pretty high.
Sounds good, but are there downsides mentioned? The usual big company stuff?
Yeah, pretty much. High pressure, feeling a bit siloed in your department, maybe challenges getting promoted or compensation not matching the demands, sometimes feeling disconnected from the top leadership. Bureaucracy, maybe a bit of fear of failure, typical stuff for a giant corporation.
So not necessarily a red flag for investors, but not a unique cultural advantage either.
That seems to be the takeaway. It's a demanding place, which you'd expect, but not described as fundamentally broken or toxic in a way that derails the mission.
Okay. Let's switch gears to the money side leadership and how they manage the company's capital. James Quincey, the CEO since 2017, how's he viewed?
The analysis portrays him as pragmatic, very focused on operations.
And his big strategic push is this total beverage company idea.
Correct. It's seen as the logical, necessary response to the slow decline in traditional sodas. It's why they've made big moves into coffee with Costa, sports drinks with Body Armor, and why there's such a huge focus on innovating low and no sugar products.
Seems like he's trying to steer the ship through these changing currents.
Yeah, the analysis suggests he thinks long-term, like an owner, focusing on making the bottling system efficient, being disciplined with where the money goes, aiming to compound value over time. They're also moving marketing towards more digital networked approaches. Doesn't seem like someone chasing quarterly numbers at the expense of the long game.
And how does that translate into capital allocation? How do they decide what to do with all the cash this business generates?
They have a very clear framework, which the analysis calls rational and shareholder-friendly. Priority 1, reinvest in the business organically, capital expenditures, CapEx. 2, pay a progressive dividend, meaning it grows over time. 3, look for smart value-adding acquisitions. And 4, return excess cash through share buybacks.
Okay, step 1, reinvestment. How much are we talking?
They aim for CapEx around 6.5% to 7.5% of revenue. Fiscal 2024 was about $2.1 billion, up 11%, mainly going into things like supply chain improvements, digital tech, and supporting those growth areas. Pretty disciplined.
And acquisitions like Costa and Body Armor.
Yeah, those are held up as examples of strategic deals filling specific gaps in their portfolio, like coffee and premium sports drinks, rather than just buying stuff randomly to get bigger.
Right, now the dividend, that's legendary for KO, isn't it?
Oh, absolutely. It's a huge part of the investment story. They have an incredible 62-year streak of increasing the dividend every single year. That sends a powerful message about stability and commitment. In FY 2024, they paid out $8.4 billion in dividends, plus another $1.1 billion in net buybacks.
The analysis mentioned something interesting, that sometimes the total cash they return to shareholders is actually more than the free cash flow they generated that year.
Yeah, that happens occasionally. It shows they're willing to dip into cash reserves or use a bit of debt if needed to maintain that commitment, especially to the dividend growth streak, even if FCF has a temporary dip.
Looking at the capital allocation table in the source, covering 2020 to 2024, you see the cash flow, CapEx, FCF.
Right, and then how it gets used. Dividends, buybacks, total returned.
Yeah.
And that last column, cash returned as percent of FCF, is interesting.
Yeah, 2024 jumps out 214%. How did that happen?
Okay, this is really important context the analysis provides. The reported FCF for 2024 was unusually low, about $4.7 billion, compared to nearly $10 billion the year before. This was because of some big kind of one-off things. A major hit from working capital changes and a big payment related to an old IRS tax dispute.
So that 214% number is skewed because the FCF denominator was artificially low that specific year.
Exactly. You can't look at that percentage in isolation. The underlying cash generation is much stronger. If you look at 2021 to 2023, FCF was consistently over $9.5 billion, sometimes over $10 billion.
Got it. So overall, the verdict on capital allocation is positive.
Very positive. The analysis concludes it's overwhelmingly rational, focused on long-term owners, and the big strategic move they made over the last decade, selling off most of their company-owned bottling operations, refranchising, is seen as strong proof. They shed lower-margin, capital-heavy assets to focus on the high-return concentrate business. That's discipline, not empire building.
Okay, let's look at the financial fortress itself. The core profitability, the balance sheet. How does KO stack up?
It's described as just a model of consistency and high profitability, an earnings machine. Even though reported revenue bounced around because of that refranchising, the underlying ability to make money is incredibly stable and substantial.
And those margins must be pretty juicy thanks to the concentrate model.
Absolutely elite. Gross margins are consistently in the 59% to 61% range. That's direct proof of their pricing power and the economics of the core business. Net margins are also really impressive, usually over 20% if you adjust for any unusual items.
The profitability table shows that, well, gross margin is super steady. There's that dip in net income in 2017, though.
Right. The analysis explains that. The net income was only $1.25 billion that year, a 3.5% margin because of a big one-time charge related to the U.S. Tax Cuts and Jobs Act. So again, an anomaly. The underlying profitability is much higher and very consistent.
Okay, so fundamentally very profitable. What about key quality ratios? Do they confirm this picture?
They really do. The analysis emphasizes return on invested capital, ROIC, as maybe the single best measure of business quality.
And how does KO look on ROIC?
Very strong and consistent. It averaged around 14.4% between 2020 and 2024, And the latest trailing figure was about 15.5%. That's way above their cost of capital and compares really well to most companies. It's the hard number that shows the moat is real and durable.
High ROIC is a great sign. What about converting those profits into actual cash? Free cash flow, FCF conversion.
They're known for being a cash machine. Management targets converting 90-95% of adjusted net income into FCF. Now again, that 2024 FCF figure of $4.7 billion, which gave a conversion rate of only 45% in the table, that was the outlier year we discussed, skewed by working capital and tax stuff.
Right, got to remember that context for 2024.
Exactly. The underlying business is very good at turning profits into cash. Just look at 2021 through 2023, where FCF was averaging over $10 billion a year. The conversion ability is normally excellent.
Okay, so strong underlying cash conversion. And the balance sheet, debt levels.
Seen as a real source of strength, giving them a lot of safety margin. They manage debt prudently, and it's actually been coming down. Net debt to EBITDA dropped from 2.8 times in 2020 to about 2.0 times in 2024. For a company with such steady cash flows, that's quite conservative, giving them lots of flexibility.
Yeah, the key quality ratios table summarizes that nicely. Solid ROIC, FCF generally strong with the 2024 note, and leverage decreasing.
So, yeah, quantitatively, the financials paint a picture of a really high-quality, resilient, well-run operation.
Okay, so we've established it's a fantastic business, great moat, financially strong, well-managed. But the crucial question for investors, what about the price? Is it a good investment right now?
Right. This is where the analysis pivots. Because, as you know, even the best company can be a bad investment if you pay too much.
So what are the valuation multiples looking like based on the mid-2025 data in the source?
The trailing price-to-earnings PE ratio is running somewhere between 28.4x and 29.2x. The price-to-free cash flow, PFCF, looks really high at first glance, around 62.6x.
Whoa, 62x PFCF sounds crazy expensive compared to the PE.
It does, but again, remember, 2024's FCF was artificially low. That 62.6x multiple is distorted. If you use a more normal FCF number, like the $9.8 billion from 2023, the analysis estimates a normalized PFCF multiple closer to 31x.
Okay, 31x normalized PFCF makes more sense. How do these current multiples, say 28-29x PE and 31x normalized PFCF, compare to KO's own history?
They're a bit elevated. The current PE is slightly above its recent 5-year average, which was more like 26.5x to 27x. And the normalized PFCF of around 31x is definitely higher than it was between 2019 and 2022, when it was more in the low to mid-20s.
So the valuation table basically shows it's trading at a premium to its recent past.
Exactly. Which leads to the analysis's main conclusion on valuation. Yes, it's a wonderful company, no doubt about that. But the market knows it's wonderful, and that quality is reflected in the price. The verdict is fair, but demanding.
Fair, but demanding, so not cheap.
Definitely not cheap. You're paying a premium price for that quality and stability. There isn't much margin of safety baked in right now. It's not a bargain hunter's dream.
What does that mean for potential returns then?
It means your return from here likely depends almost entirely on the business itself, continuing to execute well and grow its earnings and cash flow over time. You probably can't count on the valuation multiple expanding further to boost your returns. You need the underlying business to do the work.
Makes sense. It's a price that demands continued excellence. Okay, looking forward, where does the analysis see growth coming from? What are the main engines?
It highlights a dual engine, emerging markets on one hand and portfolio transformation on the other.
Okay, emerging markets first, places like Asia, Africa, Latin America.
Exactly. There's still a long runway there. People in those regions generally drink far fewer KO products per person compared to developed markets. As incomes rise, consumption tends to go up. So the opportunity is in expanding distribution even further, getting into more outlets, placing more coolers, basically, increasing availability and accessibility.
And the second engine, portfolio transformation. That's the total beverage company pivot again.
Right. This is key, especially in developed markets where traditional soda is under pressure. It's about aggressively using their amazing distribution system to push healthier options, non-soda drinks. Things like Coke Zero Sugar showing double-digit growth are vital signs this can work. And the acquisitions, Costa, Body Armor, plus partnerships like with Monster Energy, are all part of capturing growth in these faster-moving categories.
So growth from selling more stuff in developing countries and selling different kinds of stuff everywhere else using the same system. But what about the big risks, the potential permanent threats?
The analysis identifies two major ones, described as permanent and impairment risks. The first is that accelerating secular decline in sugary drinks.
That's the big health train away from sugar we keep talking about.
Precisely. It's the most powerful, undeniable headwind. If consumers move away from sugar faster than KO can successfully shift its portfolio and grow these newer, healthier categories, then the earning power of those incredibly profitable core soda brands could genuinely, permanently shrink. The analysis calls this a serious terminal value risk.
Meaning it could impact the long-term ultimate value of the whole company.
Yes. And the second major risk is punitive regulatory action.
Things like sugar taxes or plastic taxes.
Exactly. Because of the health and environmental concerns, KO is a big target for governments. Widespread taxes on sugar or plastic packaging are a real threat. They could hurt the economics badly, either by squeezing margins if KO eats the cost, or by hurting sales if they pass the cost on and prices go up too much. It's a risk of forced structural change hitting their profits.
Okay, the analysis also includes a section on second-level thinking, contrasting the general market view with a more contrarian take. What's the typical view of KO?
The consensus view is pretty much what you'd expect. KO is the ultimate blue chip. Safe, defensive, reliable pricing power, steady if modest growth from overseas, and price increases. Most analysts probably rated a buy, or strong buy, expecting low to mid single-digit growth. A smooth ride, basically.
But the analysis suggests maybe it's not that simple.
Right. The contrarian view presented is that maybe the market is being a bit too complacent, maybe just drawing a straight line forward based on recent results like those price hikes masking some volume weakness. This view suggests the future might be less of a smooth line and more like a fork in the road, potentially leading to one of two very different outcomes.
Binary outcomes. What are the two paths?
Path A is the potential underestimated bear case. This says the market is seriously downplaying that terminal value risk from the sugar decline. Maybe the core soda business is like a melting ice cube, shrinking faster than anyone expects, making the current premium valuation totally wrong. In this view, the recent pricing power isn't strength, it's just squeezing the last drops out of a declining asset.
Oof. Okay, what's path B, the flip side?
Path B is the underestimated bull case. This argues the market might be underappreciating just how powerful and adaptable that global distribution moat really is. If the total beverage strategy really takes off, if they can successfully launch and scale multiple new billion-dollar brands in coffee, tea, water, whatever, using that system, then growth could actually re-accelerate much faster than the current modest expectations.
So the contrarian idea is that investing in KO isn't just a bet on stability, it's actually a bigger wager on which of these more extreme futures plays out.
Exactly. And the market consensus might just be splitting the difference, potentially missing how good the upside or how bad the downside could actually be.
Okay, let's try to wrap this up into the one-pager summary from the analysis. The core investment thesis. What are the main points for owning KO, the bull case?
All right, the bull case boils down to 1, the unmatched economic moat from brand and distribution, giving them pricing power. 2, the disciplined capital light model leading to high profits, strong cash flow, high ROIC. 3, rational shareholder-focused management shown by smart capital allocation, that 62-year dividend streak, strategic deals. And 4, embedded growth options through emerging markets and the pivot to new beverage categories.
And the arguments against, or the big challenges, the bear case.
The bear case highlights 1, the permanent secular decline risk in core sodas due to the sugar shift. 2, the demanding valuation, meaning you're paying a full price with little safety margin. 3, the real regulatory risk around sugar and plastic. And 4, the transition risk, just the difficulty of pivoting such a huge company and the chance they spend money on things that don't work out.
The analysis finishes with a really interesting red team challenge. What's the idea there?
It's about deliberately attacking the bull case, trying to find its weaknesses. The core question it asks is, what if all that cash flow from the old soda business isn't actually funding a successful transition?
Yeah.
What if it's just being, well, the analysis says, thrown into a furnace?
Thrown into a furnace, meaning wasted. How does that argument work?
The core idea is about the potential brittleness of brand extension. What if the name Coca-Cola is so strongly tied to sugary drinks in people's minds that it actually drags down their efforts in healthier categories instead of helping? Maybe the brand magic doesn't transfer to coffee or water.
So the brand becomes an anchor, not a booster.
Potentially. In that view, buying Costa or Body Armor wasn't smart strategy. It was just spending billions in a desperate, maybe futile attempt to escape the core identity, like feeding cash into a furnace that doesn't produce lasting heat or value.
Wow. And how does the emerging markets angle fit into that negative view?
The red team challenges the assumption that emerging markets will just follow the same path as the West. What if, with rising health awareness globally, those markets kind of leapfrog the heavy sugar phase, much faster than expected. That would cut off a huge chunk of KO's expected future growth.
So the red team conclusion is pretty bleak then.
It's a stark warning. Maybe buying KO today is a value trap. You see the huge current cash flows and mistakes them for permanent health, but maybe they're just harvesting the last loyalty from a shrinking base, that pricing power. Maybe just the final act of monetizing decline. Past high ROIC is no guarantee if the core erodes and the new stuff doesn't deliver returns. You might be catching a falling knife.
That's a really challenging perspective. It forces you to question that core assumption about adaptability.
Yeah, it shifts the risk from just headwinds to potentially permanent capital destruction if the pivot doesn't succeed.
Okay, so we've covered a lot. The elegant business model, the powerful moat, the solid financials, the demanding price, the growth plans, the significant risks, and that really thought-provoking red team counter-argument.
Yeah, we see the incredible strengths that made it a powerhouse, but also the very real structural challenges it's facing now.
And the analysis leaves us with this tension. The future might not be just more of the same, but potentially one of two very different paths. Successful transformation and renewed growth, or a slow decline that outpaces their efforts to adapt.
It's definitely a more complex picture than just that iconic red and white logo suggests.
So here's a final thought for you, our listener, to mull over after this deep dive. Thinking about that red team challenge, how much risk is really priced in regarding the possibility that the immense power of the core Coca-Cola brand can't actually be transferred effectively to these new, healthier categories? Is the market assuming that Fortress can fight off deep cultural and health trends as easily as it fought off Pepsi for decades?
Right. Is the moat designed for defending against competitors selling similar things in a stable world? Or can it truly withstand a fundamental shift in what consumers actually want?
Definitely something to think about. Thank you for walking us through this incredibly detailed analysis.
My pleasure. It was a really fascinating source to unpack.